Welcome, everyone, and thank you for joining today's briefing on the latest OECD Interim Economic Outlook, which was just published yesterday. If you haven't seen the Outlook already, you can get it at the address on your screen, oe.cd40y. My name is Miguel Gorman, and on behalf of the OECD Center here in Washington, DC, and our OECD iLibrary team, we're delighted to host this briefing with two great speakers from the OECD's Economics Department, Patrick Lenain and Ben Westmore. If this is the first time you're joining one of our webinar briefings, we're particularly happy to have you here. Just a quick word about what we do. Here at the Washington Center, we're the OECD's liaison office to the United States and Canada, and we act as a resource for lawmakers, government officials, and the wider policy and academic community. And one of the important resources that we provide to that wider community is our iLibrary, which houses the latest shared economic knowledge, data, and best practices across policy areas, ranging from agriculture to trade and just about everything in between. And if you'd like to know more about iLibrary for your institution, just drop us a line afterwards and we'll be happy to connect you. I'm soon going to hand this over to Patrick and Ben so they can begin their presentation. But first, I wanted to mention that this webinar is being recorded and will be made available publicly afterwards. We will have a Q&A during the second half of this webinar, so please do type in your questions into the Q&A box as we go along, and we'll do our best to get to as many questions as possible. We're now going to hear from Patrick and Ben from the OECD's Economics Department. Their names, titles, and pictures are on your screen, and we will go into the Q&A afterwards. So, gentlemen, thank you. Over to you, Patrick.
Thank you very much, Miguel, and it's a great pleasure to be back once again to present the OECD Economic Outlook. For those of you who joined last time we presented the Outlook in June, what we are going to present now is the Interim Outlook. So the Interim Outlook is a light version of the Outlook. We cover the G20 countries, when the full Economic Outlook will cover many more countries. We also focus traditionally on the GDP growth, so it's a simplified projection. But as I will mention soon, this time around, we are also projecting inflation, which is a concern for many countries. So let me share my screen to show you the main result of our projections. So as the slide says, the recovery is well on the way, and the challenge for policymakers going forward will be to keep the recovery on track in the next few years. So the main takeaway from the Interim Outlook is that vaccination rates are increasing now very fast in all OECD countries. And that's an important background for the economic recovery. As you know, vaccination is really the precondition for reopening of our economies and for return of people to work, for return of consumers to the shops and the stores. And this is an important condition for the recovery. So vaccination rates are going up fast now, although not in the low-income countries. So I will show you some slides of that. So thanks to the vaccination making great progress and reopening of economic activity in all countries, thanks also to ongoing macroeconomic policy support, fiscal policy, and monetary policy, there is also already a strong recovery going on in OECD countries, and we expect this strong recovery to carry on in 21-22. So there is a lot of good news in this Interim Outlook in terms of economic activity and jobs and success for businesses as well. I'll say a few words about inflation, which has increased in several countries, including in the United States. We think that this surge of inflation is triggered by temporary factors, a number of disruptions in global supply chain. catch up from low inflation during the COVID crisis. One reason we think inflation is temporary is that wage growth remains stable and inflation expectations are well controlled. So I'll talk a little bit about that. So first, vaccination rates have been increasing quite fast now in most OECD countries, at least those OECD countries that are advanced economies and have been able to get access to the vaccine early on and organize the logistic of vaccination pretty fast. So what you see on your screen is the share of people who are fully vaccinated as a percent of the population. So you see there's a sort of S-shaped curve. So very slow start initially, followed by a fast acceleration. And then at the peak of the curve, kind of slowing down as we get into, people who are more difficult to reach, also get into a group of people who are hesitant in front of vaccination, and also into a group of people who actually don't want to be vaccinated. So Canada has reached almost 70% of the population. France is also almost at 70%, doesn't see much of a slowdown at all. Mexico is one of these emerging markets that has been lagging behind. They have difficulties getting access to the number of doses that are necessary to vaccinate the population. The UK is also at almost 70%. The United States had a great start, actually started faster than most countries, but has plateaued, and full vaccination is a little bit below 60%. So it's a bit of a concern. And the world as a whole is vaccinating, but with still a number of countries that are lagging behind. So you can see there from this great data provider already data, some countries have reached what might be considered as almost herd immunity, like Spain and Chile and Denmark. I was talking to people in Denmark a week ago, and life is almost back to normal. You have people sitting in the same room, they don't wear a mask anymore. China has done an incredible fast progress toward vaccination. And then if you go down the list, you see the US is in the middle of the group with a vaccination rate of 63%. And then at the bottom of the list is low-income countries. And that's a big concern, of course, because people are not vaccinated there, so they can get sick. And also there's a risk of new mutation of the virus happening in these countries where vaccination is low, there's not enough immunity, and new variant of the virus could come back to OECD countries. So as the WHO director said, we are not out of this crisis until all countries are out of the crisis. So thanks to high vaccination, mortality from COVID has declined in most countries. So what you see there is the number of new deaths per million person. So mortality was always low in Canada, so, declined further. France, mortality has also declined. You see a little bit of a wave linked to the Delta variant, but it's well under control. The UK has a little bit of a Delta variant also, it's a very small wave, but nothing compared to the first and second wave. US is a little bit of a concern. Mortality is starting to rise again, but mortality lagged behind. It is the result a few weeks later. After the authorities have taken measures. So it's more interesting to look at new cases. So new cases or variants, you can see there in as a ratio to 1 million people. again, Canada has kept the pandemic very well under control. France has a little bit of a Delta wave, but it's now declining very fast. In the UK, the Delta variant is also declining a little bit. We are a little bit concerned about the pandemic in the United States, but this chart seems to suggest that the Delta variant is also peaking now and maybe declining a little bit, with, of course, huge variation across US states. So, thanks to progress in vaccination and lower incidence of the pandemic and reopening of the economy and fewer sanitary measures, more freedom for consumers, the global recovery is very strong, especially in advanced economies. So what you see there on the left-hand side is the GDP projected for the advanced economies of the G20. In blue is the pre-pandemic projection, and in green is the latest, the Interim Outlook projection that we just released yesterday. So the good news is that the GDP in advanced G20 economy is already above the pre-pandemic level. So we have recovered all the losses of output during the pandemic. And we now project that GDP will return to the pre-pandemic trend. So in other words, all lost activity will be offset by the recovery. And we don't project any scarring effect in advanced economy. It's not the case in emerging markets from the G20 group. They have rebounded, but we don't expect the G20 emerging market economy to return to the pre-pandemic trend. So that's a bit of a concern for some countries. The details can be found on our website, and they can be downloaded from the OECD, including from the iLibrary. For the whole world economy, we expect GDP growth of 5.7% this year, followed by still very strong growth of 4.5% next year. For the United States, we expect growth year on year to reach 6% this year, to be followed by almost 4% next year. But as you can see in a number of emerging economies, the recession, like in Argentina, Brazil, Mexico, South Africa, has been extremely sharp, and the recovery will not be enough to offset this decline. In some countries, employment has already fully rebounded, and the level of employment in France and Australia is above the pre-pandemic level. In other countries, especially in emerging market economy, employment has not recovered fully. Ben will, I'm sure, will talk a little bit about that. We noted that activity in the US has returned to the pre-pandemic level, but employment has not returned to the pre-pandemic level. This is a question about getting people to return to the labor market. Now, let me turn to inflation. As I said, we normally do not project inflation during this interim exercise, but this time around, given the sharp increase of inflation in some countries, we've decided to prepare inflation projection again this time. For the US, the inflation has peaked at in terms of CPI month on month, more than 5%, almost 6%. But the phenomenon of higher inflation is also observed in the euro area in Europe. Less high, but still a peak. Less of a concern in Japan for a number of special factors. And in emerging market, you see a peak of inflation at even higher level in Brazil, 8%. And in Mexico at 6%. China is also a bit of a special factor. If you want to know about that, I can explain later on. This is our CPI inflation projection. In pink or orange here are the countries and years where we have increased our inflation projected. So you see a range almost everywhere. So we expect inflation to be a little bit higher than we thought in 21. But in most countries, you see inflation as a temporary surge in 21 and then falling down in 2022. Especially in advanced economies. In emerging markets, it will be more difficult to reduce inflation in some countries. So we've revised up, and as you can see, for emerging market, we expect inflation to slow down, but more gradually than in advanced economies. So why is inflation high? Well, in our analysis, largely due to temporary factors, disruption in global supply chain. The shipping costs have increased a lot because the international shipping industry is disrupted by the incidence of COVID. Also, there are disruptions in the supply of some commodities, metal and energy and food. So when we factor in these temporary factors in our projection, you can see that the green bar here is the increase of inflation due to higher commodity prices. So it contributes about 1% to the level of inflation, but it's expected to decline as commodity market normalize. Shipping costs explain about 0.4, 0.5% of the increase of inflation, but we also expect this to eventually phase away as international shipping normalizes. I've shown here a number of commodities and services that have risen sharply. Transporting a container around the world has increased 5 times. With some special lines becoming very expensive. Before the pandemic, it would cost $3,000 to ship a container from China to the United States. Now it costs $20,000, so a very significant increase. This is the price of aluminum, which has increased a lot, also due to disruption in supply. The price of natural gas in the UK has increased a lot. Again, there's a lack of supply of gas due to disruption that has created a debate in the United Kingdom about helping those households that will have difficulties to pay their energy bill during the winter. And speaking to our US audience, you've probably noticed that yourself, the retail price of gasoline when you go to the gas station has increased quite a bit. The price of gasoline had declined to as low as $2 per gallon during the pandemic, and now it's above $3 on average across the country. So big increase in the gasoline price also. So we expect these factors to be temporary, but nonetheless, there are 2 issues that need to be monitored carefully. One is wages. One concern would be wage price inflation. So if workers notice that inflation has increased significantly and demand higher wage growth, that would trigger a wage price circle, a spiral that would be concerned because it would increase inflation, not temporarily, but more persistently. This is not what we see. Wage growth so far has remained moderate. So for the US, wage growth has not shown any sign of acceleration, despite the fact that inflation is higher. And for the euro area, we don't see any sign of wage growth accelerating either. There are a few occupations where wages have increased a lot. In sectors that have reopened, like hotels and restaurants, wages have increased quite a bit, reflecting labor shortages. But these are just a few occupations. In general, like I say, wage growth remains stable. The other thing we look at is inflation expectation. Inflation expectation is really an advanced indicator of inflation, and that's what workers would look at when they form their wage demand. So it is interesting to see that for the very short term, inflation expected over 1 year. There's a little bit of an increase. So people in the households in the United States expect inflation to be higher within the 1 year period. But when we look at a longer time horizon, which is 5 to 10 years, households don't expect inflation to be higher than expected, and basically expect inflation to be very close to the target range of the central bank. So that means that the household expect a transitory peak of inflation, but they don't expect this transitory peak to last longer. Inflation is also seen in the housing market. We see house prices increase in many countries, which of course contribute to CPI inflation. House prices themselves do not enter the calculation of inflation, but rents do. And higher house prices will translate in higher rents and a higher inflation. Again, we expect this acceleration of rent to be a temporary phenomenon. I'll stop here. And you can find the details on our website, also on the iLibrary. And now I'll pass the floor to Ben, which will go into the details of our US forecast.
Okay, thanks very much. Thanks very much, Patrick. I'll just share my screen. Okay, you can all see that okay, Patrick? Excellent. So yeah, I will focus mostly on the US and especially about recent economic developments. I'll also touch briefly on our macroeconomic projections and talk a little bit about the risks to the forecast compared to when we last had one of these webinars in June for the release of the Economic Outlook. So similar to many other countries, the US now has data up until the second quarter of 2021. We've had that more recent data point since we last did one of these webinars. And that highlighted that the US economy has now rebounded and recovered its pre-pandemic level. It's still somewhat below its pre-pandemic trend, so about 3% below what we would have as its pre-pandemic trend. But we would say that the second quarter growth outcome in the US was solid. Consumption growth was quite strong. There were some subtractions. A lot of that consumption growth was serviced out of inventories and imports, which subtracted from growth. But I think overall, we would say that up until halfway through this year, that the recovery was very much on track in the US. Now, if we think a little bit about GDP growth in the US, and it can be instructive to look at the different components of GDP growth and think a little bit about how they were impacted in the early stages of the pandemic versus the recovery phase. And so that's what we've done here in this figure. We've got along the x-axis each of the components, and in the blue bars, we have the initial impact on each of these components in the first half of 2020. And then the orange bars shows the subsequent recovery in the year following the middle of 2020. So on the far left-hand side here, you can see that goods consumption growth subtracted a little bit at the start of the pandemic. It fell by about 2% or subtracted about 2% from annual GDP growth. But the rebound has been very, very significant and has left goods consumption well above its pre-pandemic levels. And that partly reflects the nature of the pandemic, the fact that consumption patterns pivoted away from service sectors and face-to-face consumption towards goods retailing, electronic goods, motor vehicles, household furnishings, and also the fact that there was a very big stimulus in the US that was largely concentrated on the household sector that led to higher household saving rates that allowed this sort of consumption behaviour. In the services sector, there was a very big hit at the start of the pandemic because of the initial lockdown. As the economy has gradually opened since then, services have recovered, but they've not yet recovered their pre-pandemic levels. And so you can see there that services consumption subtracted 27% from growth in the first 2 quarters of the pandemic. And subsequently, the recovery has led to an addition of about 24.5% to GDP growth. But so it's not there yet, though we would expect that as the pandemic continues to be brought under control and as restrictions are relaxed and as people become more comfortable with face-to-face services consumption, that there would be a movement back towards services activity. The other interesting points to notice here is the change in private inventories. Inventories were drawn down very, very steeply at the start of the pandemic. They've since been built back up. But in the first half of 2021, inventories subtracted from GDP growth. And the reason for that reflects some of the supply constraints that Patrick talked about in his presentation. The fact that businesses were not able to obtain the supply they needed to rebuild the stocks, and so that has subtracted from GDP growth in the recent quarters. Also, net exports during this recovery phase have been subtracting from GDP growth. And that reflects very strong imports because of strong domestic demand, and that is a result of the strong stimulus in the US compared to major trading partners. It's meant that US imports have outstripped export growth over the projection period. Over the recent period. So that was up until the middle of this year when we have the official data. Since then, it does seem that the resurgence of the virus in the US has led to a bit of a slowing in the pace of economic activity. This is the OECD weekly tracker, which combines machine learning techniques and Google Trends data to get a bit of an indication of some of the high frequency economic developments. And so that shows that the economy has weakened a little bit over the recent months as a result of some light reimposition of restrictions, but also individuals voluntarily restricting themselves from certain activities because of an increase in case numbers. The fiscal stimulus that I talked about earlier was large by OECD standards, but this figure highlights that disbursements through fiscal policy are now starting to, or have started to be wound back, and are now starting to have a negative impact on growth in terms of the government disbursements through spending or tax and benefit programs. What this graph doesn't take into account is that some of the earlier stimulus will have been saved or has been saved by households and businesses, and that will spend out over the period ahead. But just in terms of fiscal plans, as they're currently legislated, fiscal policy will start to be a drag on economic growth going forward. With the economic recovery, the labour market has also recovered. On the left-hand side here, you can see the unemployment rate having gradually declined, albeit at a slower rate in the first half of 2021 compared to the second half of 2020. The employment to population ratio, so the number of, the proportion of the population that has been in employment, has also steadily increased. What's a feature of this figure on the right-hand side is the fact that it is still well below its pre-pandemic level. And that reflects lower labour force participation rates. So the labour force participation rate for the US economy is about 1.5% lower currently than it was at that in that pre-pandemic period. And that's as a result partly of early retirements of some individuals, but also some individuals that are reluctant to rejoin the labour force in sectors where they may be exposed to the virus and as a result have stayed outside the labour force. Many economists, including ourselves, have considered that maybe some of the reduction in employment to population relative to that pre-pandemic level is because of the very generous supplementary unemployment benefits that have been offered through parts of the pandemic. We know that there's been an expiration of those, or some states have wound those back in June, and the other states will have expired those benefits in the recent month. And that really remains to be seen as to the impact on the labour market and employment growth of those expiring. As Patrick said, because of some of these constraints on labour supply, there are particular sectors of the economy that are starting to see labour shortages and starting to see some quite strong wage growth. It's not generalised in aggregate terms at the moment, but some of these sectors, such as leisure and hospitality, have seen a steady pickup in wages to be much stronger in terms of recent wage growth over the past few months compared to the pace pre-pandemic. Just focusing on the US and talking about some of the themes that Patrick also touched upon, the supply constraints in product markets also loom large. So on the left-hand side here, we have new manufacturing orders, year-on-year percentage change for the US. And you can see with this very strong demand for goods consumption in the recovery period, that this has led to a very strong increase in new manufacturing orders. That's resulted, as Patrick said, in increased shipping rates, so the increased price in shipping, but also resulted in a large increase in the delivery times for manufacturing to be supplied to these businesses. And so this figure is a little bit difficult to read, but basically longer delivery, the lower the score, it constitutes longer delivery times. And this shows that in the US, but also in the UK and the Euro area, delivery times for manufacturers are now the highest levels or longest times than they have been since before the financial crisis. So for the US, this has resulted in stronger PCE inflation, both in the core measure and the headline. The fact that this is not broadly based, that this is really a result of particular components, and some of those that have already been flagged, is highlighted in the trim mean measure of inflation. And so what this measure does is in each month, it cuts out the most volatile price increases and decreases, and that can change in terms of the components from month to month, to give a measure of underlying inflation. And you can see that that's relatively stable around that 2% level, which is encouraging in terms of the fact that what we are seeing in the headline is mostly transitory. You can see, though, on the right-hand side, that when we look at the components, some of the components around cars and also fuel oils have experienced very strong growth. You can also see that some of the hospitality sectors are starting to experience stronger growth in prices. So limited service meals have had relatively strong growth. Food from vendors has picked up a little bit. And so this may be a result of some of those higher wage pressures in this sector being transmitted into price growth. As Patrick said, when we look at financial market inflation expectations, they seem to be quite well anchored. When we look at the kind of 5-year ahead realm, the big concern is that inflation expectations of the household sector start to be factored into wage demands in order for those higher transitory prices to be compensated through increases in wages. You can see here that from the Consumer Expectations Survey, consumer inflation expectations at the 3-year horizon as opposed to the 5-year horizon have picked up a little bit. When we decompose that across the different cohorts of the household sector, this figure shows that it's typically lower income groups where inflation expectations have increased most steeply and have increased quite significantly. On the right-hand side here, we decompose it with regard to education levels and show a solid increase in the inflation expectations at the 3-year horizon of those with relatively low education levels. So just to highlight our revisions to our projections from the June Economic Outlook, we've revised down our near-term growth prospects. That partly reflects a weaker than expected second quarter growth outturn, but also the fact that there has been a little bit of a slowing as a result of the increased circulation of the virus. In 2022, we now expect somewhat stronger growth, and that's as a result of some of these transitory supply disruptions being worked out and that having a positive impact on growth. But we also expect the infrastructure bill that's currently being discussed in Congress to pass. And we also expect some increase in the fiscal deficit as a result of additional reconciliation legislation that will have an impact in 2022 that we didn't factor into our fiscal assumptions when we produced the June economic outlook. So here are our GDP growth forecasts as well as our inflation forecasts that Patrick touched upon earlier. When we look at when we think about the risks around these forecasts, there is a lot of uncertainty at the moment with regard to fiscal policy, both with regard to the debt ceiling, but also with regard to some of this legislation that's being discussed in terms of human infrastructure and the budget reconciliation bill. It could be that more of that, or what eventually gets legislated, is deficit finance. We've got a relatively conservative fiscal assumption for 2022 in our forecast at the moment. And so if fiscal policy turned out to be more expansionary than we currently expect, that would lead to us revising up our 2022 growth forecasts. One other uncertainty that is common to many OECD countries, but is especially the case in the US given the large fiscal stimulus, is that the high excess household saving rate could unwind relatively quickly if the economy reopens from here, and that pivot towards services consumption occurs relatively rapidly, and some of the pent-up demand that hasn't been serviced over the past 18 months can be accommodated. That could push consumption higher than we currently have in our forecasts. On the other side of things, we are very wary about inflation, and that's why we've covered it in this interim economic outlook. It could be that underlying some of these transitory price pressures start to become more broadly based. Some of these shipping rates start to flow through into broader measures of inflation. The increase in rents that we've seen in the market in the US starts to impact upon inflation expectations more generally, and that flows through. And as a result, it may be that monetary policy needs to be more normalized more quickly than we currently expect, and that would have that would cause weaker GDP growth than we currently anticipate. Also, as government support is wound back, some firms and households, but especially firms in exposed sectors that carry significant corporate debt, may start to see insolvencies, and there may start to be some impacts of that government support being wound back that reverberates around the economy. So I'll leave it there. Thank you very much for your attention, and I think we might have an opportunity now to take some questions.
Ben and Patrick, thank you so much for those really comprehensive presentations of the outlook. There really is a lot of great information in there. We have a question from Salim, but just before I get to that, I want to remind everyone that if you have any questions, please type them into the Q&A box. We have a few minutes, we can take your questions. But just to kick things off, Ben, I know the Fed is starting its two-day meeting today. What are you expecting to hear from the Fed, if anything, and how will that factor in? You covered a little bit in some recent slides there into your assumptions for the next outlook.
Yeah, thanks very much, Miguel. Yeah, so in a couple of hours, we'll hear from Chair Powell in the press conference about what was discussed at the Fed meeting and their expectations with regard to monetary policy. I think the thing that everyone's watching at the moment is the pace of tapering of asset purchases and what they announced there. We would expect, and I think that this is a general expectation, and there's been relatively good commentary with regard to this from the Federal Reserve in recent months, that the Chair Powell would indicate that if the recovery continues to progress, and especially the recovery in the labour market is important at the current juncture, but if the monthly payroll reports continue to show signs of improvement and reasonably solid employment growth, that the Fed would announce some tapering of asset purchases at their November meeting. So the announcement would be in November, and that tapering would start by the end of the year. And so that's kind of consistent with the remarks from Chair Powell recently about the need to start tapering by the end of this year if the recovery continues to take hold as the Fed's expecting. The other thing we'll also get as a result of this meeting is the dot plot. So we'll get an indication of what the different Fed governors are expecting with regard to their growth forecasts and in terms of their forecasts for the recovery. And also with regard to their forecasts for the lift off in the monetary policy rate. It may be that an increasing number of governors highlight liftoff in the second half of 2023 as being likely, but that's something also to pay attention to as a result of the meeting.
Fantastic. Well, lots to look out for in this meeting. We have a question from Salim, and he asks, is any forecasted recovery, if there's any forecasted recovery period for COVID-19, or I guess, well, I'll let you interpret the question.
Yeah, thanks very much. Maybe I'll pass it on over to Patrick. I think this is a general question about our forecast assumption with regard to the health situation. I would just say in the US, the assumption that we're working on is that the current increase in viruses is kind of generally brought under control. You know, that there's no overwhelming of the health system generally, and that we don't see a very large economic impact going into the fourth quarter. But I don't know, Patrick, if you want to talk more generally about our global assumptions with regard to the pandemic.
Well, thank you. I think that's a very good question, because what happens in terms of vaccination and bringing COVID-19 under control is really key to the strength of the recovery. We don't make our own forecast on the pandemic. We're pretty much in the hand of governments to give us their plans on what they intend to do with the vaccination and their expectation for reopening. Miguel, I think last time we spoke in June, I was telling you, I cross my fingers and I really hope that we're going to be able to speed up the pace of vaccination and return to normal life. It was more hope. I think this hope has been realized in a number of countries. France, from where we are speaking to you today, has returned, not to full normality, but close to it. Many of the restrictions have been lifted. The vaccination has really made outstanding progress. Still a group of people who are hesitant, reluctant to be vaccinated, but like I said, we're almost reaching 70% vaccination rate, and the vaccination is still going on pretty fast. Scandinavian countries like Denmark have basically gone back to normal. A few countries that I'm following, like Australia, New Zealand, they're really accelerating vaccination. The big surprise has been China. I think last time we spoke in June, China was very much lagging behind. There were very few people in China vaccinated. And now China has one of the highest vaccination rates around the world. So it's quite impressive what achieved there. For low-income countries, as I mentioned, the situation is not that great. Sub-Saharan Africa, there are countries still with vaccination rate of 2 or 3%. Same thing in East Asia. The good news is that the industry has done a fantastic job to ramp up production. So I think now there are 1.2 billion vaccines being produced every month. The WHO expect that by early next year there will be enough vaccine for the entire world population, and there are more new vaccines being brought to the market and new production capacity. Now, I don't want to sound too optimistic, because there are still a lot of uncertainties and risk. We hope the Delta variant will be the last one. It's a pretty nasty one, but the vaccine works. Just hope that there's not going to be a new mutation of the virus that will be resistant to vaccine. It's not. This doesn't seem to be the case right now. So let's hope it stays the same. What really matters is for people to get vaccinated. Given the effectiveness of this vaccine and the chance of saving your life by getting a shot, it's very hard to understand why people are still reluctant to do it.
Thank you, Patrick. And speaking of uncertainty, we have a question here from John about our expectations for future global trade levels. Would one of you like to address that?
Well, this is the interim outlook. It's a simplified outlook. So we just forecast GDP and inflation. We don't do a full world trade forecast this time. We will come back to you in November, I think, or early December with a full forecast and revise the world trade projection. Again, there are a number of disruptions in global supply chain. The shipping industry, they're doing what they can, but please keep in mind that if a container ship is found to have one case of COVID on board, then typically the port authorities will retain the ship at port during a quarantine period, and that creates a lot of disruption. The return to a normal level of world trade will require actually the health situation to normalize. But we'll give you, please be patient, we'll give you more details in a few months from now.
Great. And actually that's an excellent plug for our next webinar with Patrick and Ben. I was planning to do this at the end of the webinar, but since you mentioned it, I'd love to take this opportunity to invite you both back in November. I think the full economic outlook is always exquisitely timed. It's always around Thanksgiving. So we'll try to avoid having it on the Thursday or Friday, but if we can invite you back to give us a presentation of the findings of the full outlook around then, we'd be absolutely thrilled to have you. We have time for a few more questions, so please do drop in your questions in the Q&A box, and we'll get to as many of them as possible. We have a question here from Robert, and I think you've partly addressed this, saying that this is not a full outlook right now. This is just an interim look with some highlights. But he asks if we factor in any expectation that the workplace and social or leisure activities will be reduced significantly in the years ahead, even after fears of COVID-19 have subsided. And he also asks about impacts on commercial real estate and whether they'll continue to manifest themselves.
I can say a word, but I'm sure Ben would have more to say than me. But one question and puzzle is why is US GDP back to the pre-pandemic level, but employment is not back. There are still a lot of jobs that have not been filled, created, labor shortages, and employers having difficulties to recruit people. I think it's a bit, maybe Ben would have more information than me, but some people might be reluctant to go back to the workplace, in the fear of contagion. Now, I think around the world, teleworking has proved to be actually quite functional and quite effective. What we hear is that a number of employers are, looking to a mix of teleworking and office work. Face-to-face contact still useful. Think of newcomers to a workplace; they need to be trained and learn the job, so they have to get there. For some industry like the banking industry, where secrecy is a question, being back in the workplace is important. I think we're looking at something that's going to be mixed for some time to come. I guess business traveling around the world will not go back to pre-pandemic level for some time to come. We've discovered that talking to people remotely is actually not a bad thing. Ben?
Yeah, thanks, Patrick. So I think that's right. I don't think, with regard to our aggregate GDP growth forecast, both for the US and for other countries, we don't factor in significant structural changes that will impact upon economic growth in the coming 2 years. I think, kind of as Patrick alluded to, the direction or sort of the whether these changes have a positive or negative impact on growth is still a little bit contended within the economics community. In some ways, working from home in some contexts can have a reduced impact with regard to productivity growth and as a result GDP growth. But when you think about the fact that a lot of meetings now that were previously held in person and may have required long commutes into other states, to other countries, but now can be done by Zoom, really increases the amount of time that people can work, say in kind of services jobs, especially in things like professional services and the financial sector in ICT, that can actually boost productivity growth and have a strong positive impact on GDP growth. So I'd say at the moment that the literature on these competing changes and the structural impact that they'll have on GDP growth in aggregate is unclear, but a lot of work is being put into that. The question also asked a little bit about commercial property, and I think that's probably one of the things that's more certain in most countries is the shapes of cities will change a little bit as more companies move to this kind of hybrid work model that Patrick mentioned. And so that can result in different uses for different parts of the city, different patterns of urban design and urban planning, and also can result in some impact on the commercial property sector in particular areas. So I think in most OECD countries at the moment, this is a particular watch point when we're thinking about maybe the negative scarring impacts on certain types of firms that are exposed to some of these structural trends going forward. And so in a lot of countries, we are looking at the commercial property sector, and especially where there are parts of it that carry a lot of debt, or maybe we're already experiencing some sort of financial headwinds, we do see that as being an area to look at and just to monitor carefully.
Great, fantastic. And looks like we have one more question about GDP. And I know the Outlook has shown that the global GDP has now risen above the pre-pandemic level. Salim asks, with real GDP moving upwards at 2021, can it be considered as a boost up of the global economy?
Can you repeat the question again? Sorry.
Yeah, the question, as is written here, as the real GDP is moving upwards at 2021, can it be considered as a boost up of the global economy,
Yeah, I mean, those big numbers, looking at 6% GDP growth, they look fantastic. But remember, we had a big recession last year. So, a lot of it is, catching up from very low level of activity. So that's why we of course, we publish these tables, but we also like to show this graph with the level of GDP, where we compare it to the pre-pandemic level. So going back to the pre-pandemic level, which is the case in advanced G20 economies and a few emerging markets. I mean, obviously China went back to its pre-pandemic level pretty quickly. That's great, but it's not enough, right? Remember that without the pandemic, we would have GDP would have continued to grow. So that's why we're showing this graph also, where we compare the level of projected GDP to where GDP would have been without the pandemic. So it's really the return to the past trend that matters. The good news again is that for advanced G20 economies, the OECD is now projecting that GDP will go back to the past trend by the end of 22. So by the end of 22, activity will be at a level where it would have been without the pandemic. So in other words, there would be no scarring effect, no long-lasting effect. And I think it's a sign that this pandemic has been pretty well managed on many fronts. I think it's fair to say that after the global financial crisis, in 2007, 2008, the number of mistakes were down. Probably policy support was withdrawn too soon. Maybe it was not enough policy support in terms of fiscal boost and monetary policy. Also, the tapering of asset purchases happened too soon. So I think governments around the world and organizations like the OECD, we've drawn lessons from the global financial crisis. And really the idea was to provide much more support and also keep the support in place really as long as needed in order for the economy to recover fully. And that seems to be working. Again, GDP is going to go back to so no scaring effect, no long-lasting effect. So that's pretty good news. And of course, I also mentioned, the good management by the health authorities, the fantastic rollout of vaccine. The pharmaceutical companies have done a great job. Miguel, I think, 6 months ago, 1 year ago, no one was expecting, to have vaccine available, not around the world yet, but I hope soon, in such a fast time frame.
I think you're right, Patrick. And we have we're going to take one final question here, and it's from Dimitri in Brussels. And he says, first of all, thank you for the interesting presentation. But Dimitri thinks that we might be being overly optimistic here about the course of the pandemic. And he says that the WHO is not sure about the effects of vaccination that, of course, improve the situation, but they will not end the pandemic by themselves. He says that European societies are still struggling with the level and kind of restrictions, and he mentions that he lives in Belgium. So the question is, do we have a less optimistic scenario, I guess, similar to what we did with the Economic Outlook last year, where we had two scenarios?
We don't. Maybe we should, but thanks, Dimitri. I think that's a very good question. I think Dimitri is right, but it's still, a risky situation. Will we be ever able to suppress and eliminate the virus altogether? Probably not. We will have to learn to live with it, the common cold, HIV. I mean, the flu. The immunity provided by the vaccine doesn't seem to be lasting very long. We probably will have to get a booster shot from time to time for years to come. So there are downside risks for sure, and we have not prepared an alternative scenario. But so again, because of these downside risks, that's why when we talk to government, we really recommend to keep fiscal support in place. Be more selective, maybe more targeted. We cannot run huge deficit forever, but don't withdraw fiscal support as long as uncertainty and risk are still there. But I think Ben has something to add also.
Thanks, Patrick. Yeah, thanks very much for this question. I think it's a very good one. And I think that Patrick and I would both agree that, we have to make an assumption with regard to the public health situation, but there's a lot of uncertainty at the moment, and it could very well end up being less optimistic than we're currently assuming. So as Patrick said, we don't, do alternative forecasts, but I think that the one point I'd like to make is just that, when we look at the most recent resurgence in cases in the US, it's been quite notable how little economic impact they seem to have had. So, if you compared to the start of the pandemic, in the first 2 months of the pandemic, about 20 million jobs were shed in the US. When you look at, say, in August, the non-farm payrolls data disappointed everyone, but that was still an increase in jobs of about 235,000 in the month. So it does seem that countries, at least to an increase in cases, even with some of these new variants, have managed to work their way through them through alternative types of restrictions that are less damaging to economic growth. Of course, when we're talking about new variants that are much more transmissible, or have some sort of immunity to vaccination, then that changes the game completely. But I think in recent months, what we've seen in the US would give us some confidence that even if we did see another pickup in cases, maybe towards the end of the year, that the economy wouldn't be as heavily battered as it was, in some of those earlier waves.
Patrick and Ben, a huge thank you to you both for taking the time today to present the interim economic outlook to us. We're incredibly grateful. And I'd like to invite everyone back in November to hear from Patrick and Ben again when we present the full economic outlook, and that will have a lot more analysis and insights. So once again, that will be in November. And for everyone who attended today, we will be sending out both a recording of the webinar, and with Ben and Patrick's permission, if we can get your slides as well, we'll make those available to everyone who watched today. So once again, thank you to everyone for attending. It's been a fantastic presentation and really enjoyed the Q&A, and we'll see you again all very soon.